Okay, so there are essentially two different types of inflation, what we call demand pull inflation, which is caused by excessive demand or an increase in aggregate demand, and what we call cost push inflation, which is caused by a decrease in aggregate supply or increased production costs. So demand pull inflation is caused by anything that causes aggregate demand to shift to the right, which causes strong demand side conditions and therefore puts pressure on our productive capacity because the demand is starting to outweigh the supply. This occurs when we're close to our productive capacity and have higher capacity utilization. And then cost push inflation, which is caused by a shift left in supply, and that can be caused by rising production costs and any other adverse supply side conditions that limit our aggregate supply. So demand pull inflation looks like this, with basically it doesn't occur in this zone down here because we have lots of spare resources. So an increase in aggregate demand may not cause increased inflation because we don't need to raise prices because it's easy for us to increase supply in response to higher demand. Demand pull inflation occurs in this zone in here, in the intermediate zone, and then is more pronounced in the vertical zone when we're close to productive capacity. Cost push inflation is caused when the supply curve shifts inwards, when businesses are less willing and able to supply, and that causes shortages as well. Just like in microeconomics is the easiest way to think about it, when there's an increase in production costs or anything that causes the supply curve to shift to the left, that leads to higher prices. Cost push inflation is the same sort of concept. So demand side inflation occurs when the economy has very limited productive capacity and supply has reached its limit or its potential. So it's more likely to occur in a boom or a peak when we're close to full employment and there's a lack of cyclical unemployment in the economy. So examples of things that will cause demand pull inflation, and we'll go into these in more detail in future videos. Basically anything that will cause consumption, investment, government spending, or exports to increase. So that can be increased consumer confidence. Don't use that as a demand side factor, but low unemployment will lead to demand pull inflation. It's just not a demand side factor. Lower interest rates, a depreciation of the dollar, or a whole range of things that can cause demand pull inflation. Government spending, so giving stimulus packages or lower income taxes. Cost push inflation is caused by supply side factors, so an increase in wages relative to productivity. Higher interest rates can cause cost push inflation. Higher factor input costs, so higher oil prices, costs of machinery, etc. And it's just which causes a shortage of resources. Other things might be natural disasters. So here's just a whole range of other things that cause cost push inflation. So higher interest rates, lower participation rates because there's higher wages and lower productivity, a fall in the Australian dollar, and we'll talk about that in more detail as well. So we're looking at things that limit our supply potential. At the moment, it's the most important demand and supply side factors to understand is what's happening at the moment. There's a lot of things that happen theoretically, but the majority of questions are based around factors impacting demand pull or cost push inflation in 2018. It's important to recognise that with inflation only at 1.9%, there is not a lot of factors that are causing excessive inflation. We're below our target range at the moment, and therefore it's not a big issue. But two things you could talk about that are increasing demand pull inflation at the moment: the lower Australian dollar, which is boosting demand for exports, which is creating higher wages and boosting consumption, which we'll talk about, and the lower interest rates, which is boosting discretionary incomes and increasing firms' willingness to invest and consumers' willingness to spend. From a decreasing demand pull inflation, high levels of household debt have led to a tendency for people to start deleveraging or reducing their spending to try and pay off some of their loans. And the lower consumer confidence is encouraging people to save more as opposed to spend. In terms of cost push inflation, two factors that are causing cost push inflation is the rise in oil prices this year, and the depreciation of the dollar can also cause that because it increases the cost of production for businesses that are using imports in production. In terms of decreasing cost push inflation, this is the most important thing keeping inflation down at the moment. If you get an exam question on what's causing inflation to be low in Australia in 2018, it's all about low real wages. That's leading to limited keeping production costs down, helping to keep real unit labour costs down. It's also limiting spending because our wages aren't going up by much. It's one of the key things keeping inflation down in 2018. As I said to you, inflation's at 1.9%. The main thing decreasing headline and underlying inflation is the low wage pressures. Wages are growing at around, it was actually about 2.1% this year, which is considerably lower than it normally is, and that's keeping real unit labour costs low, and that's due to the high levels of unemployment and underutilisation in the workforce. Increasing headline inflation, things like lower interest rates. The the lower dollar, which is causing higher production costs and more demand for our products. Higher tobacco prices, so that's not a demand side factor, but it's a key thing causing headline inflation to increase. And the higher oil prices are having an effect on raising prices because it's raising production costs as well. Okay. Lastly, imported inflation. Imported inflation is the concept where inflation is caused by rising prices of imports rather than because domestic prices or local prices are increasing. Imported inflation can be harder to contain because when things are Australian made, if we can reduce the demand for those products, we can slow down the prices and slow down spending and therefore slow down prices because there's less demand. But if we're importing the products, the problem is we may only be like a small percentage of the total market. They may be importing them to or exporting to a lot of countries, that foreign nation. So when we reduce our demand, it doesn't have a big impact on the overall demand, and therefore it's harder to regulate prices. So imported inflation is inflation that typically originates from higher costs of imported intermediate goods, which hurt the CPI. So causes of imported inflation include natural disasters overseas and wars overseas, particularly that can decrease the price of oil and raise oil prices. If economic activity overseas is booming, there's lots of demand for resources, so it costs us to buy resources from overseas. It costs us more to buy resources from overseas as well, because we essentially there's more demand for those products. And thirdly, a depreciation of the Australian dollar can cause imported inflation. It leads to imports being more expensive for Australians, which then increases firms' intermediate cost of production, which then flows on to the form of higher prices for consumers as well. So the main factors causing imported inflation: natural disasters overseas, strong growth overseas, and when the Australian dollar is low. Thank you.